Welcome, Ben. Ben's a self-confessed first-time poster, so we might address his question. What would we consider a normal rate of duplication? I think that's supposed to be for someone in their 30s. I would buying a new investment property every 3 years be considered normal.
Who wants it?
I'll happily take it. Okay.
Right up your alley.
Okay. Absolutely, Ben. So basically, I like keeping things simple. So any investment property, right, must do two things for us. The first thing is grow in value. The second thing is bring in cash flow, i.e. always be rented, always have a tenant, be bringing in maximum tax benefits. What that means is that said property costs you very little money, if anything, out of your pocket to hold. So what that means is that you've got ample available cash flow to be able to put into other investments once that growth happens. The rate of growth is going to be dependent on what your selection strategy is. Okay, so if you're looking at either high risk, volatile markets, or maybe even regional areas, cash flow is really strong. The trade-off is that capital growth is either rapid and risky, and not doesn't have longevity, or it's going to be a bit slower. If you're sticking to capital cities, obviously they're far more stable. We talk to our clients about looking to duplicate every 2 years. So obviously, lending criteria, what you're earning, borrowing capacity, all those factors play a part. But if the property's low cost to hold, it's not hurting your borrowing capacity too much. If you've always got a tenant, you can easily afford the cash flow for the next one. So 2 to 3 years, without doubt, you're heading into the prime time of your career in terms of wage growth, late 20s, early 30s. So I reckon every third year would be pretty conservative.
Yeah, look, I think the other thing that's important to think about in that aspect as well is in a property cycle, let's talk about a 10-year cycle. You're going to have 7 years of growth and 3 years of correction or slight decline, plateau, but 7 years of growth. And each market around the country, being Sydney, Melbourne, Brisbane, Perth, and I've said them in that order on purpose, they tend to move at different times. So if you can be making sure that you're making the right investment at the right time, taking advantage of the upswing, then as the next market starts to move, you use your equity, you move into that one, you can absolutely use a 10-year cycle, absolutely grow your portfolio and build, I guess, a steady stream of long-term prosperity for yourself.